The S&P 500 received some of the most unusually bullish prints we've seen all year in 2024 just last week. And I'm going to show you some of them here. First of all, this $1.4 million print highlighted in blue, which on Cheddar Flow means it's highly unusual. This is for the out the money strike, 615, and also has the expiration end of month. So they bought this one at a spot price of 603.40. And as you can see over here on this chart, we did close the week at around 608, 607.81 to be exact. So this did appreciate nicely throughout the week. And this is only one among numerous other unusually bullish prints. Realistically, the only bearish print or unusually bearish print I saw last week was this $1.8 million put. However, this has the July 18th expiration of 2025. Very different than something that is expiring end of this month in about 3 or 4 weeks. So this one, only bearish one, and has a lot of time. So it really isn't as helpful for shorter term duration. I'm talking 2 to 4 week trade setup. So as we scroll up from here, I'll show you some of those other ones as well. You can actually see, I forgot about this one, but there is one in April too, but the same thing. This is going to take 5 months until it expires. The same thing as July. That's a very far dated put order. Yes, it is out the money, which is nice, but still it's not the same as some of these other ones I'm going to show you, like this over here. $2.9 million in premium, a lot of premium, especially for something that expires in about 3 weeks. The 612 expiration, this was out the money at the time that they bought it. And interestingly enough, they bought this at 607.77, very close to where we closed on Friday, which means they're expecting this thing to continue its rally into next week. Again, they don't have that much time until it expires, and they're expecting it to ideally go in the money. That's typically what we see with these highly unusual orders that are short duration. They're looking for it to go in the money. It's not required for them to profit for it to go in the money, but typically that is the case where these result in going at the money to in the money eventually. So another one right here, this was bought to open, and the reason we know that is because the volume of the order, 6,868 contracts, is over the existing open interest. This obviously came in above the ask, so there was some urgency with that buy order, and of course that would mean they bought this to open. So 2 super unusual bullish prints that we saw last week, including a couple other ones. This one very deep in the money, but definitely a lot of premium with that. And then over here, another 612 call, 1.5 million in premium for the yet again 12/31 expiration. So we're looking at a lot, multiple millions of premium in this 612 strike for the 12/31 expiration. Super uncommon to see not just one of these prints, but multiple in a row on different days. They didn't all come in at the same time. We're talking different days, which means they still see a reason to buy these as the days go on, which is a lot of conviction on their part. The fact that they continue to accumulate these call prints. So over here, again, bought to open. You can see here the existing volume over the open interest. Great to see prints like these, at least if you are bullish, because this helps a lot from a bias perspective for when I look at the chart over here. So what I'm going to show you here on this chart is what I'm looking at right now in terms of the technicals. We know obviously the flow is very bullish after what I just showed you from last week. Obviously, just in terms of a short-term segment, it is very bullish. We're in a valid uptrend all the way since this low from over here on November 15th. So we're looking at about 3 weeks of a valid uptrend thus far. And based on the technicals, this is buy the dip mentality, just based on the trend alone, based on the flow. I like both of those variables together. So I'm going to be looking for supports to buy off of for this week, not looking to short this, because in my opinion, you're better off going with the trend, especially this year. This has been very trend driven, mainly to the upside really. But because it's been trend driven, you want to look for dips to buy. You don't want to be the contrarian that tries to pick the absolute top. You want to make sure that you are trading with the trend. That's just what I found to work best this year. Because of that, I'm going to be looking for support. So the first one that I see is very obvious to me is actually 2. Well, one over here because of this high that printed. Anytime you see a hard rejection, and by hard I mean something that's like this over here, it's kind of aggressive in sense. You had a gap up that was immediately rejected and then led to a gap fill afterwards. This is a hard rejection. That's automatically going to act as a key resistance, and even better if it's been respected again in the future, which is exactly what happened over here. This was respected in the future. You could see by the wick, not a single 15-minute candle closed above it until it finally decided to break out over here. And because of that, I know that this is going to be a key support. Now, unfortunately, that's a way away from where we are right now. You're looking looking at about 8 points on the S&P 500. Doesn't mean it can't be hit, and most certainly it probably will get hit at some point. However, in terms of this week, we don't know if this will be hit. If it were to be hit, though, this is the highest probability bounce spot that I see in this 600 plus range, or at least 600 to 609, which is the range we've traded within for the past week. So this would be the best buy opportunity spot. But again, we don't know if that will hit this week. So in terms of what I can look at intraday, I can look a little bit higher up. And by looking at a little bit higher up, I can find that, hey, this is something similar over here. We're looking at 2 different days, Monday and Tuesday of that last week. And you can see here we had numerous rejections. And realistically, this is more like a supply zone, if anything, because, and I'll show you in a second, because there's been numerous rejections not off of one spot. Over here was a clear level, 600.82. We rejected off it here, we rejected off it here, and then finally broke through over here. But in this case, where we saw what happened last week, there was multiple rejections. We had the first one over here, then another one, and then another one at the top, and then fell down again, another one, et cetera, until we finally yapped up out of it. So in this case here, this is where I would use a demand zone, previous supply zone, now demand zone because we're above it, versus a specific level. And that's a key nuance because some people think they can only use pivot levels, kind of like this. And there certainly are many opportunities that you can use it, but it's different when you have a setup like this where it's more so of a zone. And in a zone, you're looking for some type of a drop during a valid uptrend. I'll show you it right here with this brush tool. We're looking for something like a drop into this week where we see it fall into this zone, and I can add within this zone. For example, I could add my first half at the top of the zone. So that is a terrible drawing right there. Sorry about that. I'm not sure why that happened, but you add the first half, you get the point, at the top, like around here. And then I could add the other half down here. And my risk in this case is an hourly candle close below this demand zone range. Again, yes, I realize this is 604 and we're at 608, so it's still 4 points it has to fall, but it's very realistic it can still fall within this week. And something a lot of people don't understand, at least in the retail community, at least what I've noticed, is hypothetical trade setups. That's all that I do the entire weekend is I look at setups like this. Well, first of all, I look at the flow as one of many variables, and I look for a commonality in the data, such as the call prints that I showed you guys earlier in this video. I find that helps support a bullish bias. It's not the end all be all. Then I go over to the chart over here. I start looking, okay, what kind of trend is this in? Very clear uptrend, like I just showed you here. Then I start to look for these levels, like I just showed you here. I look for the pivot level. I found another range in this case for a now demand zone, and I mark those off. Just because we are up here on 608 doesn't mean that we have to fall down and test this level. And if it doesn't, I'm completely fine with that. I do this with a bunch of other tickers in my watch list every single weekend. This is one among many different tickers that do this exact thing every single weekend without fail. And if it doesn't hit on SPY, I'm sure it's going to hit with something else. Maybe it'll hit with AMD later on in the week with whatever setup I find with that. So this is all about probability. I'm not going to force a setup. I let the setups come to me. And that is the only way. And I genuinely believe that it is the only way to long-term profitability, because you cannot force setups. You cannot say, well, we're up here around 608, so I want to find something that is going to hit this week that I know is going to hit. And it's probably likely we see 607, probably likely we see 609 this week. It's only a point off. So I'm going to look for setups based on that. Well, those are not going to be high quality, high probability setups. I rather look for those high probability setups, which would entail it falling to either this level here or even being more extreme to around 600. I'm more comfortable trading off of both those levels. We know bias is to the bull side because of factors like flow, factors like the trend, other indicators, etc. So I'm going to look for setups like this. And again, if it doesn't trigger, then oh well. Look for a different setup. If it does trigger, I'm prepared to take that trade setup. So that's my premise and how I personally trade. And the last thing I do want to mention in this video, I always like to look at the VIX, see where it's at, just for a general volatility perspective. And this is pretty standard volatility going into the end of the year. We saw that vol crush from over here because remember, we were heightened volatility for quite a while all throughout those fall months. Not really a surprise. Typically is the case, especially during the presidential cycle year. Whenever there's the new president elected, you see higher volatility. That's one of numerous variables here. Geopolitical factors were another. But then after the season and literally right after or going into the election even, we had that major drop off, and then it's just remained dormant since then, really stagnated in the recent weeks. So this is a good sign as well. It tells me that there's a lot less risk of volatility up here on the S&P 500, which is exactly what I want to see for setups like the ones that I just showed you in this video here on this 50-minute chart. So looking for either of these, I'm willing to take a long off both of them. The first one over here around 604, ideally it bounces from there, but the benefit of using the risk that I use, I'm only risking about 2 or so points depending on where the hourly candle closes in this case here. And if that fails, I know that there's an even better setup down here waiting for me with similar risk where there's a lot more potential reward, because my personal target of this would be back up to the 609 high and then potentially beyond. So that's the setup that I'm looking for this week on the S&P 500. Other than that, appreciate you guys watching this video as always. See you next time.